Thank you so much. Good evening, students. Welcome to the session. So today we are having the revisionary class on the assessment of the various entities. And as you may be aware about, this is not basically going to be a full-fledged class wherein we are going to discuss about all of the questions and the provisions. Here we are going to, solve or put more emphasis on solving the question. So that is what our emphasis is going to be for this particular lecture. Of course, we are going to revise it, but if you want to watch like the full-fledged lecture, then for that purposes, you need to go through the lectures that have been there on this particular session. But as I suggested that this class, we will be focusing on more revising this topic. Okay, so having said that, let us quickly start with it. So under the assessment of the various entities, we have the discussion around the provisions in relation to the company. So that is number one. Secondly, for the individuals. Third, for the partnership firms, HUFs, AOP, BOI. So, and then we would be also discussing about other smaller topics here, which is like tonnage tax and all of that. Fine. So with that background, let us just quickly start with it. So first we are starting with respect to the companies. So what is the tax rate for the companies? You have to give me answers because as I said, this is going to be a revisionary lecture. So you're supposed to solve these or supposed to go through the topic in advance and then, attend these kind of revision lectures so that you are able to participate more and more. So what is the tax rate for the companies? What are the different tax rates for the company? Yes. What are the different tax rates for the company, students? Yes. What are the tax rates? You have to answer the question. You have studied the tax rate, at least, you would have gone through that in the basic concepts class also. So what are the tax rates for the different companies? What are the different tax rates first for the domestic company? Yes, students, please faster. What are the tax rates? A very simple question. 115 BAA, 115 BAB. So what are the tax rates given under that? Are you with me? If you're not able to answer, at least, you can make an attempt. It may be wrong, it may be right. There's no problem absolutely with that. But you need to answer for sure. Yes. Yes, Rajesh, you're there online. What are the tax rates? Nobody knows. What are the tax rates? Yes, how can I proceed further if you're not aware about the tax rates itself? See, students, the purpose of this class is to revise with you. It is not going to happen if you're not able to participate in the class itself. So, at least, you have to go through the topics. It is not a regular lecture. The regular lectures for your batch have already been done. So you have to just, go through those lectures. And then these lectures are for the purpose of solving your doubts, for undertaking the revision. So that is the purpose of having these classes. But if you're not revising anything and directly coming for this class, you will not be able to benefit out of this class. At least you can see it in the module and tell me what are the tax rates.
22, 25, something like that.
Correct. So what is your attempt? Jan 26?
No, next year.
Okay, so next year you have attempt. So which attempt you are giving?
Uh, when is it? September. See, I've been totally out of touch for the past 30 years.
I see.
30 years. I
I
cleared
see.
my group 1 in May 1995.
I see. Okay.
Then after that, I was working. I was working abroad, and now I'm retired. And then just want to re-attend. I've registered for a fresh for the course, final group 2.
I see.
So
Good
I
that you are
just commenced.
completing your CA.
I just commenced my group 2. I mean last month only. So I've just started first 2 3 chapters of direct tax and indirect tax.
I
That's it.
see. Okay. But
So
good that you are finishing your CA at the end now.
thank you, thank you.
Yeah. Okay. Geeta, what are the tax rates for the company?
For companies normal tax rates are 25% and 30%. 25% for if in preceding previous year 20 to 23 turnover is less than 400 crore, then 25%, and above this 30%. And BBA and BAB, uh, BAB 15%, BAA 22%. And there is
Right.
a compulsory surcharge of 10% and cess 4%.
Correct. And what is the difference between the domestic company and a foreign company?
Domestic company is an Indian company which gives dividends.
No. So let me explain. Okay. So see, it's good that you're attempting, right? Because now I'm able to correct your mistake. If what happens is that if you're not answering, so we may be under impression we are knowing, but there's a slight difference in the language that we are writing and what it is actually, fine. So there are two kinds of company. So let me also share over here. If you look at it, yeah, yeah. Is it okay now? One second.
Yeah, for me it's okay. It's okay.
Okay. Yeah. So this is in the regular class that we had the discussion around what is company or what are the different kinds of company. So we have an Indian company. What is an Indian company? An Indian company is which is formed and registered under the Companies Act 56 or 2013. And then we have a foreign company, which is not a domestic company. So then what is a domestic company? So is there a difference between the Indian company and the domestic company? The answer is yes. So every Indian company is a domestic company. So company which is registered in India, formed in India, that is also a domestic company. But domestic company also includes a foreign company which has made the arrangement for declaration of dividend within India. So Geeta, when you said that, an Indian company which declares the dividend, the answer is not correct. So a domestic company is including an Indian company which is formed and registered in India and a foreign company which has made the arrangement for declaration of dividend within India. Are we getting this?
Yes, ma'am. Understand.
So there's a slight difference. It's not the Indian company declaring the dividend. It's a foreign company which has made the arrangement for declaration of dividend within India, which is called as a domestic company. Now, why is this distinction important between a domestic and foreign company?
Because of tax rates, ma'am.
Correct. Because of the tax rate. So for the foreign company, what are the tax rates?
35%.
35% flat. And what is the surcharge?
2% and 5%. 2%, 1 crore, above 1 crore to 10 crore, and above 10 crores, 5%.
Correct. So that's a foreign company. Then what is the difference between a resident company and a non-resident company? Yes.
Resident means Indian company is a resident company.
Indian company as well as a foreign company having the place of effective management in India. So Indian company and a foreign company having the poem in India is a resident company. Now again, why the residential status of a company is important?
Benefit of DTL and all.
No, to decide the scope of total income. Of course, benefit of DTAA, but also main principal purpose is to decide the scope of total income. Whether the global income is taxable in India, if it's a resident company, global income will be taxable in India. If it's a non-resident company, only the income accruing or arising or deemed to accrue or arise in India is taxable. Isn't it? So that is why the residential status is important. To decide the tax rate, it is important to identify whether it is a domestic company or a foreign company. To decide the scope of total income, it is important to decide whether it is a residential company or a non-resident company. Right? So that is why this is important. Now, whether a resident company will have the same tax rate as the domestic company. What is the tax rate for the resident companies? Yes.
Yes, it is Indian, no? Resident company is Indian, so 25 and all will applicable. But what about non-resident? I don't know, ma'am.
So a resident company also includes, a resident company also includes a foreign company having a poem in India. So for Indian company, which is a domestic company, the tax rate is same, which is there for domestic company. But if it's a foreign company having poem in India, which is a resident company, it is not a domestic company. A foreign company having poem in India is not a domestic company because domestic company is an Indian company or a foreign company which has made the arrangement for declaration of dividend within India. So foreign company having poem in India, even though it becomes a resident company, the tax rate still is 35%. Are we appreciating the
Thank you.
difference?
Thank you, ma'am.
Yeah. So what is a foreign company which has made the arrangement for declaration of dividend within India? Yes, we have seen that in the regular classes also. What is a foreign company which has made the prescribed arrangement for declaration and payment of dividend within India? So, Rule 27. It talks about the arrangements to be made by a company for declaration and payment of dividend within India. The share register of the company concerned for its all shareholders shall be maintained regularly at its principal place of business within India. The general meeting for passing the accounts and for declaring the dividends is held at a place within India. The dividends declared are payable only within India to all the shareholders. So then it can be said that the foreign company has made the prescribed arrangements for the declaration and payment of dividend within India. So if a company has a share register here, it is holding a general meeting here for the passing of accounts and for declaring the dividends, and the dividends are payable in India, then that will be treated as a domestic company. Are we clear? Then what are the widely held and closely held company, and why that is important again to identify? Yes, what is a closely held company? What is a widely held company?
Private companies closely held and public companies are widely held.
There are certain other companies also which are widely held. Government or company, or the companies owned by RBI, the Section 25 companies, mutual benefit nidhi company, company owned by the cooperative society, the listed companies or the subsidiary of the listed company. Now, it can be a private company or unlisted company. If it is a subsidiary of a listed company, it is a company in which the public are substantially interested. Right? Or if it's a private company or an unlisted company, in which is not a subsidiary of the listed company, that is a closely held company. Now, why is this distinction important? Why, we are having these two set of companies, widely held, closely held?
Because of dividend.
There are certain provisions which are applicable to the widely held company, closely held company. For example, Section 222E, grant of loans or advances to a shareholder. That is only applicable to a closely held company. Section 79, restriction on the set off of the losses in case of change in the shareholding. That is only applicable to a closely held company. Section 68, unexplained cash credit. Again, this is only applicable to a closely held company. So there are certain provisions which are only applicable to a closely held company. Right? Now coming towards the tax rate for the domestic company, what are the tax rates we discussed so far? So the general tax rate is 30%. Right? The general tax rate is 30%. What is the small company's tax rate? 25%, where the
25%.
turnover in the previous year 20 to 23 does not exceed 400 crore. So remember now, as I understand, it's a mixed group of students. So if you are attempting your paper in January 26, this is what is the turnover you have to look at for 22-23. However, if you are attempting your paper in September 26, right, or later May 26 or September 26, then in that particular case, it is 23-24. Previous year, 23-24. Yeah. I'm so sorry, there was some network issue. Okay. So if you're attempting January 26, then in that particular case, it's previous year 22-23. If you're attempting later, you have to see turnover of 23-24. It is 400 crores only. The limit remains the same, but the year changes. So please see for which attempt you are appearing. Since these are LVRC for Jan 2026, I'm only referring to previous year 22-23. In case you are not attempting Jan 2026, please see the lectures which are ongoing for the attempt of September 2026 or May 2026, in which you would see the previous year is different. Are we clear? Then what are the other two tax rates for the domestic company? 115 BAA and 115 BAB. So 115 BAA is applicable for any domestic company. 115 BAB is only applicable for a manufacturing company or electricity generation company. So what is the tax rate under 115 BAB? It is 15%. Surcharge of 10%. Which makes to effective tax rate of 17.16%. For 115 BAA, it is 22 plus 10 plus 4, which makes it to 25.168%. In these cases, the MAT is not applicable. Once you opt in for these sections, the MAT is not applicable. Understand, these are concessional tax rates which are given as an option. So you have to exercise the option. When you have to exercise the option for 115 BAA, you can exercise the option any point in time. But for 115 BAB, when do you have to exercise the option? So if you look at it, the option has to be exercised before filing your first tax return. What do we mean by the first tax return? Yes. So when the company is incorporated, after that, the first return it will file, only then it can exercise. In the later returns, if you have not exercised it in the first return, then in the later returns, you cannot do it. Are we clear?
Yes, ma'am.
So this will be only available if you exercise the option on or before the due date under 139(1). So you cannot file it or exercise the option in the belated return file. You have to exercise only in the original return. If you have not exercised in the original return, you cannot exercise in the belated return or the revised return. And once these options are exercised, these cannot be subsequently withdrawn. These would apply to all the subsequent assessment years. Are we clear about this? So this has to be exercised at the time of first return. For the 115 BAA, you can exercise at any point in time. Are we clear?
Yes, ma'am.
Secondly, now in terms of 115 BAB, what is the tax rate that is applicable to the other income? So any income which is incidental to the manufacturing or production of an article or thing, that will also be taxed at 17.16%. Any income which is covered in the chapter 12, which is, let's say, long-term capital gain under 112, short-term capital gain under 111A, these kinds of income which are there, these would be taxable at the special rate. So if there is 112, which is taxable at 12.5%, 112A taxable at 12.5% over 1 lakh, also 1,25,000, 111A taxable at 20%, these would be continued to be taxed at the special rate. So any income which is taxed at a special rate, that would continue to be taxed at special rate itself. And that is same even for the 115 BAA as well. Are we clear? However, if there is any other income which is not even incidental to the manufacturing, and in respect of which no specific rate of tax is provided. So if there is any other income, for example, interest income, dividend income, any other income, for which there is no specific tax rate provided, then it will be taxed at 25.168%. However, this will be taxable on the gross basis. This will be taxable on the gross basis. So whether you are under 115 BAB or 115 BAA, this will be taxed at 25.168% on gross basis. What do we mean by gross basis? That no deduction of the expenditure will be allowed against that income. Any short-term capital gain from the transfer of an asset, which is not a depreciable asset, in that case, again, it will be taxable at 25.168% both under the 115 BAA and 115 BAB. However, there you will get the deduction of the cost of acquisition or any other expenses. But for any other income, you will not get the deduction for any expenses. Now, what are the conditions to be fulfilled? The company should be set up and registered on or after 1/10/2019. This is only for 115 BAB. For 115 BAA, there is no condition like that. It should commence the manufacturing or production of an article or thing or business of generating electricity on or before 31st March 2024. And it should not be formed by splitting up or reconstruction of the similar business. It should not use any plant and machinery previously used for any purpose. What is the exception to this? Yes, there's one exception to this.
Imported machinery from foreign.
Correct. Imported machinery and
20% of
correct. So, if you look at it, we had done here in the normal classes that we had done. I've written somewhere. 1 second. Yeah. Second-hand plant and machinery allowed if it is imported or value of the second-hand plant and machinery is less than 20% of the total value of plant and machinery. So, what are the conditions? That it should not use old plant and machinery. But there are two exceptions. If this old plant and machinery is imported or if the value of the old plant and machinery is less than 20% of the total value of the plant and machinery, then in that case, it will be allowed. Next is it should be engaged in the manufacturing, production, distribution of manufacturing goods or research or income from the generation of electricity. However, manufacturing excludes development of computer software, mining, conversion of marbles into slab, bottling of gas into cylinder, printing of books, film production. However, these conditions of manufacturing, setup, commencing the manufacturing are not there in the case of 115 BAA. These conditions are not there. Are we clear? But what are the other conditions which are common? The other conditions which are common are for the claim of the expenditure. So it should not be claiming certain expenditure. What are the expenditures that it can't claim? So total income without taking the deduction under 10AA. 10AA is for what? Deduction for the units in SEZ. Additional depreciation. But can it claim normal depreciation? The answer is yes. Expenditure for scientific research under 35. Which kind of scientific research expenses deduction are not allowed?
other than in-house expenditure.
Correct. So any contribution to university, research association for scientific research, contribution to company for scientific research, contribution for social science, statistical research, contribution to national laboratory are not allowed as deduction. But you can certainly claim expenses for scientific research for your own business, for in-house scientific research, including the expenses incurred of the capital nature, including the expenses incurred prior to the commencement of business. Right? So that is something which is allowed. Deduction under 35 AD for specified business not allowed. Chapter 6A deductions not allowed. Which chapter 6A deductions are allowed? 80JJAA. What is 80JJAA?
New employees.
New
30%.
employees. Deduction for the new employees. 80LA. What is that? What was ATLA?
IFSC center.
Correct. Deduction for the IFSC units. ATM.
Intercompany
Dividends. Correct. So these deductions are allowed. Brought forward losses in respect of these unallowed or not allowed deduction are not allowed. Any other brought forward losses will be allowed. Unabsorbed depreciation relating to additional depreciation will not be allowed. However, unabsorbed depreciation relating to normal depreciation is something which is allowed. Are we clear? Then last one point in respect of this 115 BAA, 115 BAB is that if the income which is there is greater than ALP. So if the assessing officer believes that there is transaction between the person and this company, right? If there's a transaction between the person and a company having the close connection between them, is so arranged that the business transacted between them produces more than the ordinary profits. He is empowered to take into consideration the reasonable profits that may be derived from this particular section. So what they are trying to say is that if, let's say, for example, a company is trying to bring the profits in this company by having a transaction with a closely related person, because of which the income of the closely related person is being moved over here. So in that particular case, what they are saying is that this will be or the profits that it should have reasonably made, only that will be considered for the purpose of the concessional tax rate. Otherwise, what would happen is everybody will try to move the profits into the company which is claiming a lower tax rate. And if the value of the transaction is more than 20 crores, then in that particular case, it is called as a specified domestic transaction on which the transaction will have to be at the arm's length price. That we will learn in the transfer pricing class. Are we clear? There is no similar provision under 115 BAE. Now, what if you fail to satisfy any of the conditions of the 115 BAA, and BAB? If you fail to satisfy the conditions of the 115 BAB, then the option would become invalid and you can still opt for 115 BAA. But if you fail to satisfy the conditions of 115 BAA, then you can be only governed by the normal tax provisions. Are we clear? Yes? Yes or no? Is this clear to everyone? Any questions? Yes? Any questions? Any doubt? Is this clear? Okay?
Yeah.
Fine. So now, next is the minimum alternate tax. What is minimum alternate tax? When is it applicable? Yes, when is minimum alternate tax applicable? Yes. When is minimum alternate?
All domestic companies and foreign companies.
Yeah, but what is the applicability criteria? When is it applicable?
Book profit is less than 15% of tax.
Correct. Book profit is less than 15% of the tax. Then only the minimum alternate tax is applicable. Okay. So minimum alternate tax is applicable when you have the book profit less than 15%, the total income is less than 15%, the tax on total income is less than 15% of the book profits. Then book profits will be deemed to be the total income. And to whom it is applicable? To both the domestic company and the foreign company. Now, which kind of domestic company are not subject to MAT? Yes. Which kind of domestic company are not subject to MAT?
This 115 BAA, 115 BAB.
Correct. We just now discussed 115 BAA, 115 BAB. To them, MAT is not applicable. To the Life Insurance Corporation, to the tonnage tax company. And which kind of foreign company have no MAT applicability? Foreign company opting for presumptive tax under 44B, BB, BBA, triple B. Foreign company which is a resident of country with which India has a DTAA and does not have a PE in India. Foreign company which is a resident of a country with which India does not have a DTAA and it is not required to register under the Companies Act. For the IFSC units, the minimum alternate tax is 9%. Are we clear? Now, this 15% will be topped up with the surcharge and the cess. What will be the surcharge?
Same as normal company.
Same as normal company. And all the provisions of advance tax, interest under 234B and C will be applicable over here also. So how do you start with the MAT calculation? You start with the book profit. What is the book profit? The starting point with for the book profit is net profit as per the P&L account prepared as per the schedule 3. And then you make these specified adjustments as per the explanation 1 to section 115 GB. What are the specified adjustments? So number 1 is income tax. You have to add back the income tax. Provision for income tax. Income tax will include the income tax, surcharge, cess, interest on income tax. Whether penalties are also included? The answer is no. Even though under the normal tax calculation, the penalties are disallowed under section 37, but under the MAT calculation, since it's not a specified adjustment, it is allowed. So if penalties are claimed as a deduction under the P&L, you have to allow that while computing the book profit. You will not add back. You will add back the deferred tax and reduce any deferred tax credit. You will add back amount transferred to the reserves and reduce any amount withdrawn from the reserves. Provisions other than for a certain liability. What are the provisions other than for a certain liability means?
Is it contingent liability?
No.
Gratuity.
Sorry? What did you say, Geeta?
Gratuity.
Gratuity, yes. So provision other than for a certain liability means, it means provision for uncertain liability. Uncertain liability means for which I cannot make a reliable estimate, which cannot be reliably determined. For example, provision for warranties. Is it a certain liability or uncertain liability?
Ascertain.
It's uncertain because I can determine the provision for warranty based on the past claims, based on the actuarial valuation. But whereas provision for gratuity is an uncertain liability. Provision for uncertain liabilities have to be added back. This is also to be added back even when you calculate the normal tax. And you will reduce any amount for withdrawn for the provisions. You have to also add back provision for the loss of the subsidiary company. Transfer to the revaluation reserves. Provision for diminution in the value of asset. Dividend paid or proposed. Depreciation. Here you have to add back the depreciation as per books of account, which will include the depreciation on revalued asset, and you will reduce the depreciation as per books of accounts excluding the depreciation on revalued asset, meaning the effect that you are giving is You're adding back just the depreciation on revalued asset. But this is how you will have to make the presentation. You don't have to reduce the depreciation as per Income Tax Act. That is under the normal provision. Under MAT, you will only you will only reduce depreciation as per books of account. You will add back income exempt under 10 level 12 and reduce income add back the expenditure in relation to such income and reduce the income exempt. And you will add back the loss on the transfer of share of the SPV in exchange of units of business trust, which is a notional loss, or you will reduce the notional gain on transfer of share of SPV in exchange of units of business trust. So what have we studied about this? Why do we reduce this notional loss and why do we add this notional loss and reduce this notional gain? Yes, we have studied this also. Yes. Why do we reduce it? So if you have remembered what we have discussed in the trust class, assessment of trust class, if you see this in the context of REIT, we had done that, isn't it? That when the shareholders of the REIT, so shareholders of the SPV, give their shares and take the units of REIT, this is not regarded as transfer under section 47. And there is a notional gain or loss on this transaction, isn't it? So on this transaction here we are talking about, this particular transaction I'm talking about. Here there is a notional gain or loss which is recognized. If you look at it. So if the shareholders are a company, the P&L of the company shareholder will look like this. No notional gain or loss on exchange of shares for units of business trust. So this notional gain or loss have to be added or reduced from the book profit for the MAT calculation. And when the units of the REIT are actually sold by the shareholder, that actual gain or loss has to be added or reduced from the book profit. So that's what we are doing over here, isn't it? That's the reason why we are adding and reducing the notional gain or loss. Are we clear? Yes? Yes or no? Then see, actual gain or loss on sale of units of business trust, we are adding and reducing. So we are adding back the notional loss and reducing the actual loss, or we are reducing the notional gain and adding back the actual gain. Then share of member in AOP or BOI where no tax is payable under 86. What is this? Yes. Yes. What is this where no tax is payable under 86? Again, we have done that in respect of AOP or BOI. So, in respect of AOP or BOI, where no member has tax rate, no member has income greater than the basic exemption limit, and where the shares of the members are known. In that case, the AOP has to pay the tax as per the slab rate. And the member's share will be included in his income under section 67A, and a rebate will be allowed under section 110. Yes or no? So in this particular case, there is a taxability in the hands of member. But in a case where the shares of the members are known and the total income of the member is greater than the basic exemption limit, right? So in that particular case, the AOP is getting taxed at the rate either at MMR or at a higher rate. So the share of the member is exempt under 86 because AOP has already paid the tax. And while calculating the MAT, if the member is also a company, member of the AOP is a company, there would have been MAT. But since this share is exempt under 86, there will not be any MAT on the share of profit from AOP. MAT is excluded from the book profits. Clear?
Yes, ma'am.
Yes? Then
Your voice is breaking from for the past 5 minutes.
what, is it audible? Okay. 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 Then income of a foreign company. If the foreign company has income in the nature of interest, royalties, FTS, dividend, where the tax is payable under 115A or under DTAA, and where the tax rate is less than 15%, or capital gain on securities. In those cases also, it will be excluded from the book profit. You will less the income, add the expenditure. Then comes the brought forward business loss and the UAD. So if it's a normal company, you will allow lower off the UAD or the business loss. And in case either is zero, then the allowance will be zero. In case of a company which has gone for the insolvency and bankruptcy proceedings, then you will allow the aggregate of the UAD plus business loss. Then income in respect of royalty chargeable under 115 BBF. What is this section, income in respect of royalty chargeable under 115 BBF? Yes. What is this section? 10% tax. Yes, Geeta, correct. It's a 10% tax which is in respect of royalty from patents registered and developed in India. Right? So in that particular case, since it's taxable at lesser than 15%, you will less the income and add the expenditure. Fine. Let us look at one question to understand how do you now consider the MAT impact, and you have to answer all the questions in relation to that. So ABC Private Limited incorporated on 1/11/2024, engaged in manufacturing of footwear and has set up a factory in the Northeast. It has reported a net profit of 80 lakh for previous year 24-25. The following items have been credited to the P&L. Contribution towards the research association eligible for deduction under 35(1)(2) for rupees 2 lakh. So, first of all, what is the tax rate that it should consider? Whether it can opt for 115 BAB. No, Geeta, why? Because incorporated after 31st March 2024. Very good. So, what is the condition for the 115 BAB? Though it's a manufacturing company. But what was the condition? It should be set up on or after 1/10/2019 and should commence the manufacturing before 1/4/2024. This is incorporated itself after 1/4/2024. So how can it commence the manufacturing before that? So therefore, in that case, 115 BAB will not be, 115 BAA will not be applicable. Yes. So then can it claim 115 BAA, which is 22%? Yes. Or it can claim 30%. Because, or can it claim 25%? Can it claim 25%? Yes, why, Geeta? Because incorporated in current year. So you can take a view that since it is incorporated in the current year, it doesn't have a turnover in previous year 22-23. So obviously it means it was less than 400 crores because it had the zero turnover and it can claim 25%. So yes, it can claim 25%. It can claim 22% plus 10%, which makes it to 25.168%. Now you will say, ma'am, what is the difference between 25 and 25.168? If you add 25 plus 4%, how much does it become? Yes. Twenty-five plus 4, 26%. So should we compare 26% with 25.168% directly and say that 25.168% is more beneficial and one should go ahead with that? Should you compare like this? Yes. How should you compare? No, Geeta, you don't have to compare the headline rates. You need to compare that when I take 25.168%, number one, I have to forgo certain deductions. So because of forgoing this deduction, whether my effective tax is higher than what I will claim as per the tax rate of 26% after claiming all the deductions. Because that's headline tax rate is lesser, 25.168%, but you are also losing out on deductions. So you have to compare the effective tax, whether effectively when you forgo the deductions and offered at 25.168, whether that is better in comparison to claiming all the deductions and paying at 26%. Plus, when you pay at 26%, if your tax on the total income as per 26% is less than 15% of book profit, then you would end up paying MAT at the rate of 15%. But if you pay as per the 25.168%, there will not be any MAT. So that also you have to compare. Then the comparison will be between 15 versus 25.168. But 15 is on book profit, 25.168 is on the net profit as per the or the total income as per the computation provision. So here you have to compare all the three aspects. Are we getting it? Yes or no? So let us solve this question in that way. So first is contribution towards research association eligible for deduction under 3512 for 2 lakh. Whether this is allowed under the 115 BA. No, right? Whether this is allowed under the normal tax provision. Yes. Right? So first comparison will be between this. You will add back under 115 BAA and you will consider this deduction under the normal provision. So under the normal provision, you will be getting this deduction. But when you talk about the 115 BA, you will disallow this item. Yes or no? What about under the MAT? Whether this is allowed under MAT? Yes, this is allowed under MAT. Right? So this is what I have already written the answer. Net profit is 80 lakh, starting point, contribution to research association, add back in the 115 BA. Expense towards in-house R&D of 2 lakh. Allowed under 115 BA or not? Yes. Allowed under normal tax provisions? Yes. Allowed under MAT? Yes, right? So under all the three, this is allowed. So I'm not adding back. Next is depreciation as per books of account. What would you do under the normal provisions? Add back under 115 BAA? Yes, under 115 BAA. Under 115 BAA, how is it allowed, Geeta? There also you will add back, right? The depreciation as per books of accounts. Yes. And under MAT? Add back. So under all the three, I'm adding back the depreciation as per books of account. But under MAT, you will again allow the same amount because there is no depreciation on revalued asset, which has to be excluded. So under MAT, I will exclude the same amount. I'll reduce the same amount again. So this is how you will present in exam also. Fine. Then royalty received from patents developed and registered in India 10 lakh. Expenses on royalty 1 lakh. What about under the normal provisions? Yes. Add back because it's taxable at 10%. Yes, Geeta. So under the normal provisions, you will add back the expenses and reduce the royalty income. Right? You will not add back the royalty income. Royalty income is already added in P&L, so you will reduce. You will add back the expenses. What about under 115 BAA? Yes. So the 22% no. So if you recollect here, what did I say? In the case of 115 BAA, income taxable at a special rate will be taxed at the specified rate itself. So this is the income which is taxed at a special rate, students. So under 115 BAA also, this will be taxed at a special rate itself. So in the normal provision also, you will reduce 10 lakh, add 1 lakh. In the 115 BAA also, you will reduce 10 lakh and add 1 lakh and consider this as a separate income as 10 lakh under both normal as well as under the 115 BAA. And this is taxable at the rate of 10% on the gross basis, meaning the expenditure will not be allowed. What about in the MAT? What about in the MAT? Same. Under MAT also, you will reduce the income and add back the expenses. Because on this income, there is no MAT. Fine. STCG on transfer of listed equity shares on the recognized stock exchange of rupees 10 lakhs. What will happen under normal provision? You will not add back, Geeta, right? You will reduce. We will reduce this. This is the income, not the expenditure. So we will reduce from the normal provision. Because this is taxable at the rate of 20%. You will reduce. You will not add back, Geeta. What about in the 115 BAA and MAT? First, what about under 115 BAA? Same. You will reduce. What about under MAT? No effect. Because it's not a specified adjustment, so under MAT, there will not be any effect. So STCG 10 lakh reduce under both. And consider this as a separate income. Fine. Then other information is given: asset acquired and installed during the previous year, plant and machinery worth 1 crore, 20 lakh paid in cash. So what is this for the purpose of? Yes. On 20 lakh, you will not allow depreciation. So meaning on 80 lakh, you will calculate the depreciation. What is the rate of depreciation that you will allow? On 80 lakh, depreciation at the rate of 15% and additional depreciation at the rate of 20%. Very good. So since it's a manufacturing company, there will be additional depreciation. Right? So on 80 lakh, 15%, we are not aware about that whether this is put to use for less than 180 days or more than 180 days. So we'll allow for entire more than 180 days itself. What about under 115 BAA? Under 115 BAA, we will only allow normal depreciation of 15%, no additional depreciation of 20%. Fine. Building rupees 50 lakh. What is the rate of depreciation on building? 10%. This will be allowed under both the 115 BAA as well as the normal. So this is my depreciation as per section 32 under normal, and this is under 115 BAA because this doesn't include the additional depreciation. So I will reduce that. Then the company has employed the new employees to whom salary paid was debited to the P&L account, details of which are here under. On 1/11/2024, 2 employees were hired with 18,000 account with the salary of 18,000 per month paid through account paid check. What is this for? %30 expenses allowed? No. Yes. So this is for the purpose of claiming the deduction under 80JJAA. Right? Under 80JJAA, which is the employee cost allowed as a deduction, 30% of employee cost. So these two employees are hired on 1/11/2024. So how many days it becomes? Yes. So 30 days for November, 31, 28 and 31. It comes to 151 days. How many days the employee should have been there? 150 days, right? Because this is manufacturing of footwear. For manufacturing of footwear industry, instead of 240 days, you consider if the employee has been employed for more than 150 days, is an eligible employee. Here the salary is paid by account paid check and is less than 25,000. So what is the deduction that I will consider? 2 employees into 18,000 into 5 months into 30%. Right? This is monthly salary. This is on 1/12/24. 4 employees are employed, 25,000 by ECS. They're allowed? No deduction allowed. Why? Because less than 150 days. The employees are employed for less than 150 days. But you may allow for these employees in the next year if they stay for more than 150 days in the next year. Right? This should be 1/11/2024 again. 1 employee, 28,000 by check. No deduction allowed, right? Because the salary is more than 25,000. So it's an ineligible employee. Then again 1/11/24, 25 employees, 11,000 in cash. So amount paid in cash, again not allowed. So we will also, since this amount is debited to the P&L account, we will also disallow under 48(3), the expenditure in cash. We will disallow. So what we will disallow is 11,000 into 25 employees into 5 months. So we will create a disallowance here, expenditure in cash. 11,000 into, sorry, this should be, I think, 5 months. Into 25 employees. Are we clear? So how much does it come to? 13,75,000. And this we will disallow under normal as well as 115BAA both. Whether 80JJAA is available under 115BAA? Yes, it is available under both. So we will allow the 80JJAA under both. So this will give me my total income. Now what I will do is, on the 10 lakh rupees of royalty, I will charge the tax at the rate of 10% under 115 BBF. Right? On the STCG, I will charge at 20% under 111A. And this will be same under both normal tax provision as well as the 115 BBF. Both the 115 BAA. Both the provision. On balance income which is left, which is basically my GTI minus royalty minus STCG minus 80JJAA. On that income, I will calculate under the normal tax provision 25%, and here I will calculate at the rate of 22%. And since this income is more than 1 crore, I will add the surcharge at the rate of 7%. Now first I will compare this tax liability under normal provision with the MAT liability. On my book profit, I will apply 15%. And since my book profit is less than 1 crore, there is no surcharge, only cess. So since my tax on total income is not less than MAT, then MAT is not applicable. So this is my final tax liability. This I will compare it with the tax under 115 BA. Now since it is better here, I will opt for normal tax and not for 115 BA. Are we getting this point? So this is how a question can be asked in the examination. So when they say compute the tax liability, and when they do not say ignore 115 BAA, 115 BAB, you have to consider normal tax, you have to consider MAT, and then you have to also consider 115 BAA. Are we clear, students? Any questions, any doubt? Okay. Yes. Any questions? Okay, let us solve one more question on MAT from the module. Sona Limited, a resident company, earned a profit of 15 lakh after the debit or credit of the following items to the statement of P&L for the year ended on 31st March 25. Provision for the loss of subsidiary. So here they are only asking you to calculate the minimum alternate tax and not the normal tax. And here they are saying you ignore the provisions of the 115 BAA also. So for the MAT, provision for loss of subsidiary, what is the effect?
Add back.
You will add back, correct? Provision for doubtful debts.
Add back.
Why do we add back this? This is provision for diminution in the value of asset. Right? This is provision for diminution in the value of asset, for decreasing the value of asset. So that's the reason why we are adding it back. Provision for income tax.
Add back.
Provision for gratuity based on actuarial valuation.
It is allowed actuarial valuation, so allowed.
It is based on the actuarial valuation. It is not just like that. So if it is based on actuarial valuation, which is estimated by an actuary based on the past calculations, then in that particular case, it is a provision for an ascertained liability, not an unascertained liability. And therefore, we will not add back. Clear? Depreciation.
Add back.
Interest to financial institution which is unpaid before filing of return.
No effect, ma'am.
No effect. So even though under 43B, you will disallow this under the normal tax, but under MAT, there will not be any effect. Penalty for infraction of law.
No effect.
No effect. So even under 37, you will disallow, but here no effect. Even for the gratuity, you will disallow under 40A9 or 40A7. But here, you will allow it. Profit from unit established in SEZ.
No effect in this.
You will reduce, right? Because this is exempt under section 10.
10, 11, 12. Yes, ma'am. Yes.
Yeah. Share in income of an AOP as a member. So they have given here the AOPs of which the company is a member has paid tax at the maximum marginal rate.
Reduce it, ma'am.
Reduce because the income is exempt under 86 in the hands of member. Income from units of UTI.
No effect, ma'am.
No effect. It will not be reduced. Okay. Next is long-term capital gain on sale of building.
Not.
No effect. Depreciation includes 1,50,000 on account of revaluation of fixed assets.
We have to reduce it from this depreciation.
360. So we will reduce from 360 and reduce the balance amount from the book profit. Depreciation as per income tax rule, no effect. Credit. So what is my MAT credit? My MAT credit is the difference between the tax liability and the non-tax as per the normal provision and the MAT tax. Right? This MAT credit will be allowed to be set off against the normal tax liability in the future year. So this credit can be carried forward for a period of 15 assessment year. So for example, if my MAT is 4,50,000, normal tax is 395, I pay 450. So my MAT credit will be 55,000. In the next year again, my MAT is 470, normal tax is 410, so I pay taxes per MAT. So again, my MAT credit will be 60,000. So 55 plus 60,000 I'll carry forward. In the next year, my MAT is 380 and taxes, normal tax is 4. So I'm paying the normal tax. So then the difference between the two will be allowed as MAT credit. So I'll actually end up paying 380 only, not 4 lakh. Are we clear? Fine. So let us take a break over here. And then after the break, we start back again with one last provision of the MAT and then we'll move forward. So let's take a break here. Okay. So next thing, students, that we need to discuss is in respect of the companies which are complying with the Indian accounting standards. Now, if a company complies with the Indian accounting standards, it has to make certain additional adjustments to the book profit for companies complying with the Ind AS. Now, what are the adjustments? You need to make the adjustments with respect to the items that form part of the OCI that shall never be reclassified to P&L. You don't need to make adjustments for the items that shall be reclassified to P&L. Right? What is OCI? What is OCI? Other comprehensive income, isn't it? So there may be certain items that may be classified under the OCI. Now, if these are put under OCI to reduce the book profit, there may be a problem. So the items which get reclassified to P&L eventually, that we will include it in the year when they will get reclassified. But for the items that will never get reclassified to P&L, that we need to include it in the book profit. But we need to also exclude certain items from that. So what are the items that we will exclude with respect to that? So we will exclude, we will basically here consider the items which are all credits and less debit. However, we will exclude certain items, for example, revaluation surplus for assets, because this is notional amount. Because this we will include it at the time when the assets are disposed of. So actual gain or loss, we will include it at that point in time. Second, gain and losses from investment in equity instruments designated at fair value. Again, this is notional. We will include it when there is actual realization. Third, remeasurement of defined benefit plan. This also we will include it when in the year when there is actual gain. Right? So this is the adjustment that we need to make. Second is in respect of the demerger in the hands of the shareholder. So any amount debited to P&L on distribution of non-cash assets to the shareholder in demerger, the difference between the book value and the fair value, that we need to add it. And any amount credited to P&L on distribution of non-cash assets to shareholder in demerger have to be reduced. For the resulting company also, you will ignore the difference between the book value and the fair value. Right? So when it is a case of demerger, the shareholder will get some non-cash assets also, which may be the shares of the resulting company. So Ind AS 10 provides that any distribution of non-cash assets have to be accounted at fair value. So the difference between the fair value and the book value may be taken to the P&L. So that is a notional gain or loss. So that we need to reduce it or add it. And finally, in the case of the adoption, in the first year of adoption, there may be a transition amount. So in the first year of adoption, what happens is the companies will be required to prepare the Ind AS financial statement. But it will have to also convert its last year financial statement to make a comparative financial statement. So it will have to make certain adjustments in the last year financial statement as on the opening date. Right? So therefore, the transition amount which is there, that has to be 1/5 of that has to be added in this particular amount or reduced. So what does the transition amount will include? Amounts appearing in other equity on account of transition from AS to Ind AS. Other than the capital reserve and the security premium reserve. But it will exclude amount adjusted in OCI under the head item that shall be reclassified to P&L. Revaluation surplus, notional gain or loss on investment designated at fair value, notional gain or loss on plant property and equipment, and intangibles designated at fair value, notional gain or loss relating to investment in subsidiary, JV, associates recorded at fair value, differences relating to the translation difference of foreign operation. All of this we need to exclude it. Are we clear? Any questions? Fine.
Yes, ma'am. It's very difficult, ma'am. Let's learn how to learn this.
I will explain you. Let us do a question and you will understand this. So in the normal lectures, you can go through the lectures on assessment of various entities where we have discussed this in detail. So there also you can see that. So ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu, started adoption of Ind AS with effect from 1/4/2022. The following particulars are furnished for 31st March 25. The book profit after adjustment of all specified items amounted to 52.26 lakh except for adjustment of brought forward losses for the year ended 31st March 25. Brought forward losses as per books of account for financial year 21-22 is this, for financial year 22-23 is this. The business loss of 4.6 lakh and 1.75 lakh have been deducted while computing the book profit under 115 JB for financial year 21-22 and 22-23 respectively. Now, the NCLT has admitted the application under Section 7 made by the financial creditor against the company for initiation of insolvency proceedings. So what do we need to do with this? Brought forward losses.
Full amount we have to take, ma'am.
Correct. But out of which 4.6 lakh and 1.75 lakh have already been deducted in 21-22 and 22-23. So this year we can only deduct these two amounts because the other two have already been reduced in the earlier years. So I can't allow a double deduction, right? So since they have been already considered, I will now only allow the unabsorbed depreciation, right? Fine? Yes or no?
Yes.
The particulars of OCI for the year ended 31st March 25 rupees in lakh. OCI that may be reclassified to PNL. Now you have been given different items with respect to this. Will you consider this OCI that may be reclassified to PNL? No. So OCI that may not be reclassified to PNL, only those are to be considered. OCI that may be reclassified to PNL is not to be considered. Right?
Okay, ma'am.
Then under OCI that may not be reclassified to PNL, changes in the fair value of equity instruments. Whether we will consider this 10? No, because this is a notional gain or loss. We will not consider this. Then deferred gains on cash flow hedges. We will consider this. We will consider this amount. What we will consider over here?
7.25 lakhs.
Correct. But would you add it? Will you reduce it? What will you do?
Add it, ma'am.
So this is a credit which is given. So the credit have to be added. So deferred gain on the cash flow hedges have to be added 7.25. Then deferred cost of hedging share of OCI of other associates. This we will reduce 4.1. Remeasurement of post-employment benefit obligation 4.45. This we will again add back. Then share of OCI of other associates. This we will again add back. Revaluation surplus of assets. This we will ignore because again this is a notional item. Then the transition amount as on the conversion date stood at 52.50 lakh, including the capital reserve of 8 and adjustment of 4.5 relating to the translation difference in foreign operation. So this is a credit balance 52.50 lakh, out of which what I will do is I'll reduce the capital reserve 8 lakh and 4.5 lakh relating to the translation in foreign operation. So balance 40 lakh divided by 5, 1/5. I will add the amount because this is credit. And this will give me my book profit. Simple.
Yes, ma'am. Its solution will be.
Solution will be sorry.
It is there in portal.
No, it's not there. So you can, we have done this in the regular class. So you can find the solution over there.
Okay, okay,
So
ma'am.
yeah, this is what the solution is. So this book profit 52.26 lakh less unabsorbed depreciation that has not been considered. So we will consider that add the credits that I discussed, less the debit that I discussed, and add the 1/5 of the transition amount. Fine.
Yes.
Okay. Next is, so see, these are the classes that we are doing for the revision purposes. These are not the regular classes. So if you want to watch the regular classes, you have to go to the regular classes and watch those, because here we are only going to do it on a very fast track basis as a revision. Fine.
Yes, ma'am.
Then let us move towards the next topic, levy of buyback tax. So what is the provision for the buyback tax? Is buyback tax applicable? No. Buyback tax was applicable before 1st October 2024. What is after 1st October 2024?
It is income from other sources.
It's income from other sources treated as a deemed dividend. And the cost of acquisition is allowed under section 46A as a capital loss, which will be adjusted against the capital gain only. Fine.
Yes, ma'am.
Okay, so this is buyback tax which is applicable before 1st October 2024. So then the next topic is special provision relating to the shipping companies. So there is a tonnage tax scheme which is applicable for the business of operating the qualifying ships. What do we mean by the business of operating the qualifying ship? So in case of these tonnage tax companies, you have to see it is applicable to whom. It is applicable to a Indian resident companies plus companies having the POEM in India. So an Indian company plus a foreign company having the POEM in India, it is applicable to Indian resident company having at least one qualifying ship, which means it should have a minimum tonnage of 15 tons. It excludes sea-going vessel, ship carrying goods or services, fishing vessels, factory ships, pleasure craft for sports or recreation, harbor and river ferries, offshore installation. These are not covered. What is a qualifying ship? Qualifying ship having tonnage up to 1,000. The income, daily tonnage income will be 70 per ton. If it is between 1,000 and 10,000, it will be 700 plus 53 per ton exceeding 1,000 tons. Greater than 10K, less than 25,000, 5470 plus 42 per ton. Greater than 25,000 will be 11,770 plus 29 per ton exceeding 25,000 ton. And with respect to the tonnage, if it is greater than equal to 50, you have to round off to the next number, which is next 100. If it is less than 50, you have to round off to previous 100. Once you have claimed the tonnage tax income, it operates like a presumptive income. You will not be allowed any deduction under 30 to 38. No losses other than tonnage loss will be allowed. No Chapter 6A, only depreciation is allowed. And tonnage losses can only be set off against the tonnage income. Plus, they have to mandatorily transfer 20% to the special reserves, which is to be used to acquire the ships within 8 years. If you do not acquire the ship within 8 years, it will be considered as a deemed income. Right? So, whether MAT is applicable to a tonnage tax company?
No, ma'am, you told this.
MAT is not applicable. So, a company which is having the tonnage tax income, it is not required to pay the tax under the MAT. There is no MAT applicable. And remember, this has to transfer the amount to the special reserve, just like we had seen in the case of tea, coffee, rubber development. Are we clear?
Yes, ma'am.
Okay. And this is an optional scheme. It is not a mandatory scheme which is there. It's an optional scheme. So you have to exercise the option. And if you do not utilize the amount which has been credited to tonnage tax reserve, or utilize for other than purchasing the ship, or if the ship is sold within 3 years from the purchase, then to the extent of reserves unutilized, the income will get taxed. Or if you do not deposit in the tonnage tax reserve account, so to the extent of shortfall, you will have to, it will be considered as your deemed income.
Yes, ma'am.
And remember this particular thing, that this company tonnage tax is an optional scheme, it is not a mandatory scheme. So let us look at a small question from your module, which will help you to understand how do we calculate here. So there is this net tonnage, for example, given. This is days for which the ship operated. So see, if it is 1020, it is less than 100. So it is rounded off to the previous 100, which is 1000. 8563, it is rounded off to 8600. It is greater than 50. This is 22,368. This is more than 50. So 22,400. Round off to next 100. 37,525. This is less than 50. So round off to previous number 37,500. And then you have to calculate the daily tonnage income based on this particular. Right. So for example, this is 1000. Net tonnage is 1000. So up to 1000, it is 70 for each 100 tons. It is 70 for each 100 tons. So 70 for each 100 tons for 1000 tons, how much it would be? 700. Similarly, this is 8600. So this is exceeding 1000 but not more than 10,000. So it is 700 plus 53 for each 100 tons, exceeding 1000 tons. Right? So for 7600, it will be for 53 for 100. Then for 7600, it will be how much? Plus the 700 that you have to do, it will give you 4728. Now this is the daily tonnage income. You have to multiply it by with the number of days. And this is how you calculate your tonnage income. Are we clear?
Yes, ma'am.
Okay. Let us move to the next topic then. Taxation of the other entities, right? Alternate minimum tax. Now, alternate minimum tax is applicable to whom? Yes,
Individual HUF.
any person other than company, which has claimed the deduction under Chapter 6A, heading C. What is heading C?
Section 80 IA to 80 RRBs.
Correct. Deduction in relation to other income. Or claim the deduction under 35AD. Or claim the deduction under 10AA. And if the adjusted total income is greater than 20 lakh. Here they are not using the word book profit. Here they are using the word adjusted total income. Who are not required to pay AMT? Individual HUF, AOP, BOI not opting out of 115 BAC. Or a cooperative society opting for 115 BAD or BAE. They are not required to pay AMT. What is my AMT? Adjusted total income into 18.5%. For IFSC, it is 9%. For cooperative society, it is 15%. So if my normal tax is less than 18.5% of adjusted total income, AMT will be applicable. So how do I calculate the adjusted total income? Total income, add Chapter 6A heading C in relation to income, excluding the deduction under ATP. ATP is not to be considered under adjusted total income. Add back deduction under 10AA for SCZ. Add back deduction under 35AD minus the depreciation under 32. So if I have claimed the deduction under 35AD for a specified business of a capital asset, all right, but I still need to allow 32 depreciation, because if I'm disallowing the deduction, I still would have granted, if I would have not claimed 35AD, I would have still claimed depreciation on that capital asset. So I will exclude the depreciation. This will give me the adjusted total income on which I will calculate the AMT. What will be my AMT credit? Just like MAT credit, you can claim the AMT credit, which is AMT tax minus the normal tax, which is also allowed for 15 assessment years. So this is just like your MAT itself, but here what is additional is that here you need to just add back the deductions. Yes or no?
Yes, ma'am.
Okay. So again, in case of AMT, the questions can be asked is that, if you would have calculated tax as per normal provision, then you have to compare it with AMT. Or if you go for 115 BAC, then what would have been the better approach? So that is how you will have to consider. Again, in the normal lectures, in the LVC lectures, we have considered a comprehensive sum on this. You need to go through that sum to understand how the AMT has to be calculated. Are
Yes,
we
ma'am.
clear?
Yes.
So, see, what you need to do is, with respect to the AMT, you need to see that whether you're claiming the deduction under any of these sections. It is not that the AMT will always be applicable. AMT is not always applicable, students. You need to see whether if you have claimed deduction under these section, any of these section, only then the AMT gets applicable. Let us look at that question, which will help you to understand it in detail. Let me do one thing. Let me open up the question from PGBP. Yeah. Let us solve this question, because then, it will be a good revision for you. Mr. A commenced the operation of business of setting up a warehousing facility for storage of food grain, sugar and edible oil on 1/4/2024. He incurred the capital expenditure of 80 lakh, 60 lakh and 50 lakh respectively on purchase of land and building during the period January 24 to March 24, exclusively for the above businesses, and capitalized the same in its books of account as on 1/4/2024. The cost of the land included in the above figure is 50 lakh, 40 lakh and 30 lakh respectively. During the previous year 24-25, he has incurred a capex of 20 lakh, 15 lakh and 10 lakh respectively for extension or reconstruction of building purchased and used exclusively for the above business. The profit from the business of setting up a warehousing facility for storage of food grain, sugar and edible oil before claiming the deduction under 35AD and 32 for the AY 25-26 is 16, 14 and 31 respectively. Assume in respect of expenditure incurred, the payments are made by account pay or ECS. Compute the income under the head PGBP for the 25-26 and the loss to be carried forward, assuming A is exercising the option. So this you don't have to look at it. We are assuming here that you have to just calculate the income and the tax liability. Let us assume this particular point is not mentioned over here. So what would have been better for him? Should he go for 115 BAC and not claim 35AD? Should he go and claim 35AD? And if he claims 35AD, you have to compare it with the AMT liability. So first we'll look at the normal tax provision. Now, which particular businesses would be eligible for 35AD?
Warehousing facility for food grains and sugar.
Warehousing facilities for food grain and sugar. That's right. For edible oil, it will not be eligible. So first we'll calculate 35AD deduction. How do you calculate? What is the 35AD deduction on?
Revenue expenditure is allowed and also capital expenditure except land, financial instruments, I think,
And
and
goodwill.
one goodwill.
Yeah. So here he has incurred the capital expenditure of 80, 60 and 50 on the purchase of land and building. And it has been capitalized in the books of accounts as on 1/4/24. So can we claim the prior period expense?
Yes,
Because
ma'am.
he has started the business after 24, 1/4/24.
Yes, prior period will be books of accounts are maintained and it is shown in the books of accounts.
Correct. So prior period, if it is capitalized in the books of accounts, you have to include it under the deduction of 35D. But from this 80 and 60, what we will exclude?
Land expenditure.
We will exclude the land. So we'll only consider 30, which is 80 minus 50. So here I am considering 30 and here I am considering 60 minus 40, 20. Correct? And then there is a current year expenditure, capital expenditure of 2015. So this I will also include it here, 20 and 15. So my total capex is 50 plus 35. I will allow this deduction of entire capital expenditure, including prior period, against my profits from the specified business. Yes or no?
Yes, ma'am.
Right? So my loss from the specified business of setting up and operating a warehouse facility, it is 34 and 21. Can I set it off against the normal business income?
No, with specified business only.
It has to be with the specified business. Then we have profit from the edible oil business, 31. And here also we have the prior period expenses of 50, which has been capitalized now. So 50 minus land 30, 20 lakh plus the current year 10. So on this 30 lakh, I will claim the depreciation at the rate of 10% for building, which comes to 3 lakh. So my income chargeable is 28 lakh, right? So this on this 28, I will calculate my normal tax liability as per the slab rate, right? Yes or no?
Yes, yes, ma'am.
Okay, so what does the tax liability come? Can you calculate it for me, please?
Seven lakhs 41,000.
Did you include the cess also?
Yes, ma'am.
It shouldn't be 741.
No, ma'am, it's 6,78,600.
28 lakh minus 10 lakh, right? Into 30%. Six lakh 78,600.
Yes, ma'am. 678,600. Yes.
Correct? Now, if you calculate, let's say for example, if I do not go for the 115, sorry, if I go for 115 BAC, then in that particular case, what should be my total income? But before that, we will consider that what is the AMT liability. So for calculating the AMT, what I would do is I would start with the total income. Yes or no?
Yes, ma'am.
What is my total income?
It's 28 lakhs.
28 lakh. I'll start with 28 lakh. I will add the deduction under 35AD. What is my deduction under 35AD here? 85.
Yes, ma'am.
Yes, I will add this. minus the depreciation under section 32 on this 85 lakh. If I would have not claimed 3580, I would have allowed the depreciation. Yes or no?
Yes. Yes, ma'am.
So I will reduce 8.5. This comes to 76.5. So my adjusted total income comes to 104.5 lakh. On this, what is the AMT coming to?
20.1058,
How 20.1058?
including cess, ma'am, 4%.
But what about surcharge?
18.5%.
Because the income is more than 1 crore. So
Yes,
there will
ma'am.
be surcharge of how much? What is the surcharge rate? This is individual. What is the surcharge?
15%, ma'am.
15%. So you will add the surcharge and cess. I think it comes to 23.12167.
Yes, ma'am,
Correct.
23.1267.
Now
Yes.
my AMT is greater than the normal tax. So I will have to pay as per the AMT. Yes.
Yes, ma'am.
If I pay as per the AMT, I'll get the AMT credit of difference between the two. Fine. Now if I go as per 115 BAC, then what I would do is I'll consider my all the profits. What is the total profit? 31 lakh plus this 30 lakh. Yes or no?
Yes, ma'am.
Then I will claim this depreciation of 3 lakh plus on this capital expenditure. If I'm not claiming 3580, what will I claim? If I do not claim 3580, what can I still claim?
Depreciation.
Yes, you can claim the depreciation, which is coming to 8.5 lakh itself. So my total income will come to 49.5 lakh. What is the tax under 115 BAC?
Up to 3 lakhs nil, 3 to 7, 10%. Sorry, 5%. Uh, 10 to 12, 10%. 12 to 15, 20%. And above.
Correct. So here the answer may look different because this is for May 2026. For earlier attempt, the slabs were different. So your answer will be different. Right? But any which ways, this will come as a lower because the total tax on total income itself is my lower. So it is better to opt for 115 BAC. So this is how you have to solve the question. If a question doesn't tell you, ignore MAT. Or if a question doesn't tell you, ignore 115 BAC. Are we clear?
Yes, ma'am. Yes.
Okay. So see students, in the examination, it is very, very important that you understand and read what the question has been about. Whether the question is on AMT or not, if the question is on total tax liability, then you have to calculate the total tax liability itself, which will include all your tax liability under the AMT as well as normal tax provision. Are we clear?
Yes, ma'am.
Okay. Now, under AMT also, similar to the MAT, all the normal provisions which are applicable to the normal tax will also be applicable over here. Which means what? You will have to pay advance tax. You will have to pay the interest in the 234B, 234C if you do not pay the advance tax on time. And AMT credit is also allowed for 15 years. Okay. Let us solve now few questions from the module itself. So that we get a hang of it. Okay. Park Hospitality Limited is engaged in the business of running hotels of 3-star category. The company's statement of P&L for the previous year ended 31st March shows a profit of 152 lakh after debiting or crediting the following items. Payment of 0.25 lakh and 0.30 lakh in cash on 3rd December and 10th December respectively. For purchase of raw corn to Mr. Raja, an agriculturist, and Mr. Khalid, a spice trader, for purchase of masala used for corn products respectively. Now here the question is asking us to do what? The question is asking us to compute the total income, indicating the reason for treatment of each item, assuming that the company is not eligible for deduction under 35D. Ignore the provisions of the MAT and the provisions of 115BA. See here the question is specifically telling us ignore these provisions. So then we have to only compute as per the normal tax. Okay. So what will be the impact of this?
For agriculture's cash payment is allowed. This 30,000 is not allowed.
But that is also a purchase of corn, isn't it?
It is from trader, no ma'am?
It is from a spice trader. So is it saying only from the agriculturist, or is it saying that the agricultural produce? What does the law say?
Agriculture produce.
Yes, agriculture produce. So basically, in respect of this, the payment to a middleman who is a trader, that will be disallowed. So disallowance is attracted under which section?
48.3.
48.3. So if it is made to a farmer, an agriculturist, for purchase of raw corn, that is covered under the exception of 6DD. However, to a trader, it is not covered. So under 48.3, there will be disallowance of the 0.3 lakh, which is 30,000. 0.25 lakh, which is 25,000, that will be covered under the 6DD exception. Contribution towards the employees pension scheme notified by the central government under 80CCD for a sum of rupees 3 lakh calculated at 12% of the aggregate of basic salary and DA, forming part of retirement benefit payable to employees in terms of the employment.
Allowed, ma'am, because it become, I think, 14%.
Yes, it is 14%. That you are right. So this is 14% and therefore here it is 12%, which is well below the prescribed limit. So this will be allowed. Payment of 6.5 lakh towards the transportation of various materials procured by one of its hotel to Messrs. Bansal Transport, a partnership firm without deduction of tax at source. The firm opts for presumptive taxation under 44AE and has furnished a declaration to this effect. It also furnished its PAN in the tender document.
30% disallowed, ma'am.
Why it will be disallowed? Are we required to deduct the TDS on the transporters?
If pen and this furnished, so no declaration is also given, so no need.
If the declaration is given, but there is also a restriction in terms of how many vehicles they own.
Yes, ma'am. 10 vehicles. Yes.
Yes. So here whether you will disallow or not. Where is it given? It is 10 vehicles.
But it's opted for presumptive tax. If he has a 10 vehicles, then only he has opted.
Very good. So you have to make a reference that one can only opt for presumptive taxation under 44AE only when you have lesser than 10 vehicles. And only when you have lesser than 10 vehicles and you have furnished a declaration, then on the payment made to a transport company, there is no tax deduction of TDS required under 194C. Right? So in this case, there will not be any disallowance. Clear?
Yes, ma'am.
Profit of 12 lakhs on sale of plot of land to Avimanyu Limited, a domestic company, the entire shares of which are held by the assessee company. The plot was acquired by Prarik Hospitality on 1st June 2023.
It's capital gain, ma'am.
Yes. So
So separately taxable.
so you have to do what?
First add profit is there, no? So less we have to deduct it, and then separately we have to calculate its tax.
But will we tax this particular profit under head capital gain? So yes, we have to reduce from the PGBP. But under capital gain, this is taxable.
It's entire shares, so no, ma'am. It's no
Why?
capital gain.
What is the reason for that?
100% owned by it.
Yes. So, sale of capital asset to a wholly owned subsidiary, which is an Indian company, is not regarded as transfer under section 47(4). Right? So, this will be not regarded as a transfer and will not be taxed under the head capital gain. Fine. Contribution of 2.5 lakh to IIT with a specific direction for the use of the amount for scientific research program approved by the prescribed authority.
Allowed under normal provision.
Allowed under normal, right? So here no further deduction allowed. So this will be allowed, no adjustment. Expense of 10 lakh on foreign travel of two directors for a collaboration agreement with a foreign company for a brewery project to be set up. The negotiation did not succeed and the project was abandoned.
It's not allowed, ma'am, because it is a different project, brewery
Yes.
project.
So this is for a new project. This is for a brewery project and the current company's business is running hotels of 3-star category. So if the expenditure has been incurred for a new business which has not been materialized and which has been abandoned, the expenditure is of capital nature and will not be regarded as a revenue expense. So this will be capitalized and will be disallowed. Right? Fees of 1 lakh paid to independent directors for attending the board meeting without deduction of TDS under 194J.
30% is allowed.
30% disallowed. Depreciation charge 10 lakh. Add back.
Add back.
10 lakh being the additional compensation received from the state government pursuant to an interim order of the court in respect of land acquired by the state government in the previous year 22-23.
Disallowed, ma'am.
Disallowed, we will reduce, right? This is received. This is on the
Yes, yes.
income side. So we will reduce it from the PGBP. But what will be the tax impact of this?
Income from other sources.
No. So this is received pursuant to an interim order of the court. The same would be taxable under the head capital gain. So enhanced compensation on the compulsory acquisition of the land is taxable under the head capital gain. But it will be chargeable in the year when I get the final order. So it will not be chargeable in this year. So even though it is received, this is received pursuant to an interim order. I cannot tax it because tomorrow in the final order, the court may say this was not payable, so I will have to refund back to the court. Right? So this will be not taxable at all in this year. So you will reduce it from the PGBP, but you will also not offer to tax under the capital gain. Fine? Dividend received from a foreign company 5 lakh in which it holds 15% of the equity share capital.
15% will not, it is income from other sources. Here we will reduce it.
Right. Here you will reduce it from PGBP and offer it under IFOS. Additional information, as a corporate debt restructuring, the bank has converted the unpaid interest of 10 lakhs up to 31st March 24 into a new loan account repayable in 5 equal installments. The first installment of 2 lakh was paid in March 2025 by debiting the new loan account.
Only 2 lakhs will be allowed because this is restructuring, and whenever amount is paid, it is allowed.
Correct. So conversion of the unpaid interest into loan is not regarded as payment of interest for the purposes of section 43B. When the new loan installment is actually paid, then only you will get the deduction. So you will only get a deduction of 2 lakh. Fine. Depreciation as per the Income Tax Act, reduce 15 lakh. The company received a bill of rupees 2 lakh from a supplier of vegetables for the supply made in March 2025. The bill was omitted to be recorded in the books in March 25. The bill was paid in April 2025 and the necessary entry was made in the books then.
Action will be allowed, ma'am.
It will be allowed, right? Because the company follows which method of accounting?
Accrual basis.
Accrual basis, right? Mercantile. So you have to allow all the purchases which have been actually made. Now here it has been omitted by mistake. But you will consider on the system of the mercantile basis itself, which is the purchase was there in the March. It was paid in April. That is a different story. But you have to allow on the mercantile system. So here we will reduce the 2 lakh amount. Jacob, your question is on, can you explain point D isn't considered as a transfer? This one. This is the 47.4 section, which says that transfer of a capital asset by a holding company to a wholly owned subsidiary, which is the Indian company, is not regarded as transfer by virtue of the section 47.4. I hope that's clear, Jacob. Next is dividend of 7 lakh is distributed on 25th of September 2025 to its shareholder. Yes.
And back.
What will be the impact?
When dividend paid, at that time it is allowed.
So this will be allowed as a deduction under ATM. So you have received a dividend of 5 lakh from a foreign company. And in the same year, before 1 month before the filing of return, you have distributed it. Yes or no?
Yes, ma'am.
So this will be allowed as a deduction under ATM. What will be allowed as a deduction? To the extent of the amount received, which is 5 lakh. So 5 lakh will be allowed as a deduction under section ATM. Yes or no?
Yes, ma'am.
Okay. So this is how you will compute your total income for this question. Any question with respect to this? Okay, let us solve one more question. Question number 1. XYZ Limited is engaged in the manufacture of textile since 1/4/2009. Its statement of P&L shows a profit of 700 lakh after the debit or credit of the following items. What are we required to do? Compute the total income, tax liability. Ignore the MAT and the 115 BAA. So again here they are telling you to ignore the MAT and 115 BAA. The turnover of XYZ for the previous year 22-23 was 405 crore. So can you use 25% 25% tax rate?
30%.
30%. Okay. So depreciation calculated on the basis of useful life of assets as per the provision of Companies Act, add back. Employers' contribution to EPF of 2 lakh for the month of March 25 were remitted on 30th June 2025.
Employers' contribution allowed, ma'am, but employees' contribution should be made before 30th May, 31st May. So it is not
20th, right?
allowed.
20th May. So employee's contribution has not been deposited before the due date of the PF Act. Therefore, you will not allow this as a deduction as per section 36(1)(5)(a). So this will be regarded as your income under 224(10) and will not be allowed as a deduction. Employer's contribution, since it has been paid before the due date of filing the return of income under 139(1), it will be allowed under section 43B. So you will only add back 2 lakh. The company appended a note to its income statement that the industrial power tariff concession of 2.5 lakh was received from the state government and credited to the statement of P&L.
Yes, ma'am, it is right, ma'am.
You will consider as your income at the 224, right? So any assistance from the central government, state government is considered as the benefit or perquisite, right? Under 28(4). So this will be considered as my income. This is not relating to any capital asset. If it was relating to a capital asset, I would have capitalized it. So this is considered as my income and therefore it is rightly added. The company has provided an amount of 25 lakh being sum estimated as payable to workers based on the agreement to be entered with the worker union towards the periodical wage revision once in 3 years. The provision is based on a fair estimation of wages and a reasonable certainty of revision once in 3 years.
Allowed, ma'am, because it is a revision. It is based on fair estimation and reasonable certainty. So it is allowed, ma'am.
So as per ICDS, which ICDS allows this? Which is the ICDS?
No, ma'am, I don't know.
ICDS 10. ICDS 10 provides that if the provision can be recognized, provision for expenses can be recognized, only a reasonable and a reliable estimate can be made in respect of that expenditure. There is a reasonable certainty that there will be a future outflow of the resources. Yes or no? So in that case, you will allow the expense. So there is a present obligation arising out of past event. There is a reasonable certainty that there will be outflow of resources to settle the obligation, and a reliable estimate can be made. And this, your estimate has been made reliably, so this will be allowed. The company has made a provision of 10% of its debtors towards bad and doubtful debts. Total sundry debtors of the company was 200 lakhs.
It's allowed, ma'am, because if in books of accounts it written, then it is allowed.
No, it is not allowed. So it's a provision for doubtful debts. It is not actual bad debts. So if a provision for doubtful debts is there, this is only allowed for only one set of companies. Which are those? Banks, public financial institution, state financial corporations, state industrial investment corporation, and NBFCs. Under 3618A, sorry, 3617A. Right? This is not allowed for all the companies. So provision for doubtful debts will be disallowed. Okay. So here 200 lakhs into 10% will get disallowed because it has made a provision of 200 lakhs ka 10%. A debtor who owed the company an amount of rupees 40 lakh was declared insolvent and hence was written off by debit to the statement of P&L.
It is allowed, ma'am. It is not provision.
Correct. This is actual bad debts. So bad debts written off in the books will be allowed. So here no adjustment is required. Sundry creditors include an amount of 50 lakh payable to A and Co towards supply of raw material, which remained unpaid due to quality issues. An agreement has been made on 31st March to settle the amount at a discount of 75% of the outstanding. The amount waived is credited to the statement of P&L.
Disallowed.
No, this is the income. This is the discount given by or the waiver given by the sundry creditors. This is not my expense. The amount was payable. Now I don't have to pay because 75% of that 50 lakh has been waived off. So technically this is my income.
Add back.
Sorry?
No, minus profit.
No. This is rightly considered as income. So under section 41(1), if there is a benefit obtained in respect of remission or cessation of the trading liability, right? If a benefit is obtained under section 41(1) in respect of cessation or remission of the trading liability, then in that case, it will be considered as my income, deemed income. that benefit shall be deemed to be the BGBP in the year in which benefit is obtained. So here I have obtained that benefit on account of waiver of this liability by my creditor. So this has been rightly considered in my P&L and there is no effect required to be given. Fine. The opening and closing stock for the year were 200 lakhs and 255 lakhs. They were overvalued by 10%.
So net effect of this overvalued value we have to.
Yeah. So what we will do? Whether you will add, whether you will less.
Less 5.5 lakhs.
Yes. So 200 lakhs, 10% of 200 lakhs, let's say 20 lakhs is added to my opening stock, which is overvalued. So with the increase in opening stock, what will happen? My profit will decrease because opening stock comes on my as an expense, isn't it?
Yes, ma'am.
And closing stock, if it is overvalued by 25.5 lakhs, this will add my profit because this comes as an income. So opening stock will reduce my profit, closing stock will take my profit. So to the extent of 5.5 lakh, difference between the 20 lakh and 25.5 lakh. By 5.5 lakh net difference, my profit is higher. So what will I do? I will reduce the profit by 5.5 lakh. Fine. Provision for gratuity based on actuarial valuation was for 500 lakhs. Actual gratuity debited to the gratuity provision was 300 lakhs.
Net effect of 200 lakhs we have to give.
If you had to compute the income under MAT, if you had to compute the book profit under MAT, would you allow this provision for gratuity 500 lakhs? Under
Yes, ma'am.
115 JB.
Actuarial valuation. Yes.
So under 115 JB, we will allow this 500 lakh because this is a provision for a certain liability. But under the normal provision, under the normal computation of income, we will disallow by virtue of a specific disallowance under section 40A7. Right? Under 40A7, the provision for gratuity, even if it is based on actuarial valuation, is not allowed. So I will disallow 500 lakhs and I will allow actual of 300 lakhs. So in effect, 200 lakhs will get disallowed. Commission of 1 lakh paid to a recovery agent for realization of debt. Tax has been deducted and remitted as per chapter 17B.
No effect, ma'am.
No effect because the tax has been duly deducted. Are we clear?
Yes, ma'am.
The company has purchased 500 tons of industrial paper as packing material at a price of 30,000 per ton from PQR, a firm in which majority of the directors are partners. PQR's normal selling price in the market for the same material is 28,000 per ton.
Yes, ma'am. Related party transactions. So arm's length price. So 2000 into 500 we have to Add back.
Correct. But do not use the word arm's length price. Because under 48.2, you have to use the term fair market value. The arm's length price has been deleted long back from 48.2. So the difference between the purchase price, which is 30,000, minus fair market value, which is 28,000, use the words carefully, because if you use arm's length price, your marks will get deducted. So 2,000 per ton into 500 tons. You have to multiply because this is per ton. Have to be added back since the purchase is from a related party, a firm in which the directors are a partner. Are we clear? Some additional information is given. There was an addition to the plant and machinery amounting to 50 lakh on 10th June 2024, which was used for more than 180 days during the year. Additional depreciation has not been adjusted in the books. Will this company get the additional depreciation? This is engaged in the manufacture of textile.
Yes, ma'am, 20% full.
20% full. So I will get an additional depreciation on this amount, which comes to 50 lakh into 20%, 10 lakh. Normal depreciation is 80 lakhs. So this we will reduce from the profits. The company had credited a subcontractor an amount of 10 lakhs on 31st March 24 towards repairing a machinery component. The tax so deducted was remitted on 31st December 24.
30% disallowed. Next year allowed it is because after return filing date.
But technically, the company has said this in the additional information.
Yes, ma'am. Yes, ma'am. In current year only, yes. This will last year's 30%. This year will be allowed.
Correct. So this we are preparing the total income for the AY 25-26, which is previous year 24-25. So this is the information for the last year 31st March 24. And we are looking at previous year 24-25. So in previous year 24-25, they have deposited the amount. In the last year, this was not allowed. So in the current year, when they have remitted the money, remitted the tax, we will allow this. So in the last year, 30% of 10 lakh would have been disallowed because the tax was remitted after the due date of return. But now in this year, this 3 lakh will be reduced from my total income. The company has collected 7 lakh as GST from its customers and paid the same on the due dates. However, on an appeal made, the High Court directed the department to refund the 3 lakh to the company. The company in turn refunded 2 lakh to the customers from whom the amount was collected, and the balance of 1 lakh is still lying under the head current liabilities.
One lakh will be added back, ma'am, which is
Under
not
which section? Under 41(1). So again, this is a benefit which has been received, right? So this refund of 2 lakh, which is there, sorry, 3 lakh, which is there, this is a benefit which has been given, my refund. And out of which 2 lakh, I have made the payment to the customer. So 1 lakh is still my benefit. So under 41(1), this will be considered as my deemed income. Clear?
Yes, ma'am. Ma'am, how to remember these sections?
See,
I
you will
don't
have
know.
to practice. You will have to do a lot of practice to remember these particular section numbers. So only when you keep saying these section numbers again and again, look at them again and again, only then you will be able to remember this. There's no shortcut to remember these section numbers. Okay?
Last September 25 exams also, ma'am, I get 40 DT, but my marks are not increasing. What to do? How to practice it, ma'am?
See, uh, DT is a subject which requires a lot of practice and everyday touch because if you leave even for one day, you might forget. So, how many papers of yours are left still?
Not a single cleared, ma'am.
Only one is cleared.
Not a single cleared. Last time I've
Okay, not
given
a. Okay. So, are you attempting for all the both the groups or only one group?
this last time I have appeared for both the groups, and in May I have appeared for one group, second group only.
Okay. And now you are planning for again?
Means, I have prepared, but I am not giving full time, ma'am, because
Okay.
I am
See,
housewife.
okay, no problem. See, I mean, doesn't, like matter how much time you are devoting, like everybody has other commitments. So that is not a problem. It's, in fact, commendable that you are still able to, devote some time, listen to the lectures, and also, sit for these kind of examination which requires this kind of intensive study. So really kudos to you for managing along with your house. So, I mean, my suggestion will be that, give one group at a time because that will help you to study properly. Because what happens is that if we, focus on two groups, there is too much to study and you would not be able to manage it effectively with other things also, right? So better is to go for one group at a time. Secondly, when you are talking about the direct tax paper, when you prepare for direct tax, as I said that keep on practicing the papers, keep like the past papers, the mock papers, keep on practicing each and every question from module. And practice when I mean is as per what is actually written in module, like a proper presentation. So how it is presented in the module, you have to present in a similar manner in examination to gain more marks. Because presentation is very, very important. How we use the words, like for example, I told you, you don't have to use ALP, you have to use FMV. So when you compare your answers with the module, only then you will be able to appreciate, okay, I have written this word, but the module says this. So what module says is actually required in examination. So we tend to do a very rough kind of practice when it comes to DT. Like, right now also due to the paucity of time, of course, we are doing like this. But this is not the correct approach. You don't have to say, okay, add in less. The ye add hoga, ye less hoga. Nahi. You have to make proper notes. You have to solve every question like that. Then only you will get hang of the provision because under tax law, the wordings are very, very important. So that only you can do when you practice well. And every day just look into one chapter ka 4-5 provisions that will help you to effectively then recollect, okay, this is what section number is, this is what section number is. So do that. And with the limited subjects, if you take one group, you will be able to easily remember all the section numbers also. And see, you don't have to remember entire income tax act ke sare sections, at least the major ones like PGBP, capital gain, like that.
Okay, ma'am.
Okay. Any other
Means,
questions? Yeah.
yes, ma'am. DT and in IDT also same thing, but multidisciplinary. Because of multidisciplinary, I have to learn all the subjects. Otherwise, it's very difficult, ma'am. So,
Yeah. No, it is, of course, for multidisciplinary paper also you have to remember. But see, under multidisciplinary, आपको section number कौन से इसमें आते हैं? You have to study DT, IDT में. Company law तो अब इतना है नहीं. Right? Audit में again there are no section numbers. So which all
yes,
section numbers you are supposed to refer to? So it is majorly DT and IDT. At least when we were doing CA, we used to have like Companies Act also. We used to have the Income Tax Act also, and Companies Act is also as voluminous as Income Tax Act. Then
yes,
under like when I was studying my CA, that time we had the excise law, we had the service tax law, we had the customs law. Now it is a consolidated GST. So for me, it was so difficult to remember the section numbers of income tax, of companies, of excise, of customs, and of service tax, which is like very problematic. You have like now GST and income tax. You would be able to recollect if you do everyday practice. And GST में इतना ज़्यादा complicated नहीं है as compared to income tax. Like वहाँ पर see your question also when it comes, you have to remember, okay, whether this is an exempt service, whether this is taxable service, whether this is a negative list, or whether this is having zero rated or whatever. Here you have so many provision. DT is a like a module itself altogether, or it's a group itself altogether. So you have to pay more attention to this because यहाँ पर बहुत minute चीजें हैं. Like for example, when I saying like provision for a certain liability allowed under MAT, gratuity as per actuarial valuation, but not allowed under 40A7. So these are the points which you should make note of as an important points to be revised before exam day. So that will help you building that.
Yes, ma'am. Thank you.
Yes. Any other question? Any problems that anybody else is facing? See, when you are also coming for the LVRC, please revise and come, because that way you will be able to answer more effectively, because these are revision lectures. The actual lectures have already been done.
Yes, ma'am. Definitely, I will
Yeah.
follow.
Because क्या होता है कि जब आप रिवाइज करके आते हो तो you will have more questions. You will start understanding more कि okay, this is what I have read and now I am able to understand. Because see, I am teaching. My job is done over here, but your job is more to like understand what I'm teaching, and that can only happen when you put in your hours. So any lecture that you will watch will have only limited impact, but what you do as your own reading, own writing will have a larger impact on your examination. Fine. So I think we'll close here for today. We'll meet in the next class on Friday. Thank you so much.
Thank you,
Ma'am,
ma'am.
ma'am,
Yes.
the point K, right? Regarding that no, the transfer related party, right? If it's the amount is like, if the sale is lower, then is it, should we add back or something?
No, see, this is for the expenses. When the expenses are higher than the fair market value, then you need to add back. If your sale is lower, obviously you don't need to, do any impact on that unless the transfer pricing is applicable. So if it's a question of transfer pricing being applicable, wherein your sale is recorded lower as compared to what is the arm's length price, then you certainly need to make an adjustment. But where there is no question of TP applicability, then in that case, you don't need to make any adjustment.
So we did the adjustment because the amount is more, right?
Yes. So as per 40A2B, and for the expenses, the adjustment is required. Right? Thank you so much, students. We'll meet in the next session. We can close the session, Manishji. Manishji?
Manish ji, ma'am, you can leave.
Sorry?
You can leave.
Okay, thank you.